Oasis Petroleum filed Chapter 11 last month, but its subsidiary Oasis Midstream has not been affected. It's still an operating business. Let's look at Oasis Midstream and see if it's a buy or sell according to my model. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Oasis Midstream stock by analyzing their financial ratios and dissecting their financial statements, so we can determine if the stock is a buy or a sell. Oasis Midstream is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a really small company, 242 million market cap, and they're trading at $7.26 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding 33 million. Let's look at their financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. And if a company has positive free cash flow, it makes it easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. This company has negative free cash flow in 3 of the 4 years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And then net income looks good. It's positive and growing each year. Their revenue grows a lot from year to year. It grows 34%, 33%, and 34%. So they're growing at a great rate. And they have really healthy profit margins. Their net profit margins are 33% up to 54%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. Let's look at the financial statements to see why they had negative free cash flow. So to calculate free cash flow, it's operating cash flow, which is up here, minus capital expenditures. So in 2016, they had 72 million of operating cash flow, and they spent $157 million in CapEx. So that's why they had negative free cash flow in 2016. So each year they do spend a lot in CapEx. So they're aggressively growing their company, which is why their revenue is increasing so much. Also in 2017, they purchased a business for 74 million. In 2019, they purchased another business for 24 million. They seem to be doing a really good job growing their business organically and through acquisitions. So even though they have negative free cash flow, I wouldn't be too concerned because they have healthy operating cash flow and they're doing a good job growing their business. And if this company keeps growing at this pace, they can be a really big competitor in the oil and gas midstream industry. Let's look at a capital structure. They have $459 million of debt, $605 million of equity. They pay 3.83% interest on their debt, and they don't pay taxes because they're a master limited partnership. To qualify to become an MLP, the business must generate at least 90% of its revenue from natural resources or real estate. And 43% of that capital structure is debt, which means 57% is equity. And their cost of equity is 22.67%. And to get the cost of equity, we use the capital asset pricing model. And part of the CAPM model is the beta. The beta is how volatile the stock is relative to the market. The market as a whole has a beta of 1. This stock has a beta of 2.65. So it's a really volatile stock. So the stock moves more than 2.5 times the market. The higher the beta, the higher the volatility, and the higher the cost of equity. And their WACC is 14.5%, which is a blend of the cost of debt and cost of equity. And the WACC is a discount rate companies use when they want to take on new projects to see if they provide a good return or not. And the WACC is a discount rate we're going to apply for this model. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 213 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $288 million. We divide that by 33 million shares. And we get a calculated stock price of $8.63. They're trading at $7.26. So they're trading at a 16% discount. It's a buy according to the model. It was really hard to value this company with so much negative free cash flow, so I had to use my most conservative model. Simply Wall Street is way higher. They're at $15.15 a share. The way Simply Wall Street gets its valuation is based off of the average analyst estimate. The stock price was trading well over $20, but it's come down quite a bit. It's at a really low point, so it looks like it could be a really good value. The company IPO'd in 2017. They paid their first dividend in February 2018, 78 cents. That's a big dividend. They cut it in half the next quarter, and they've been raising it ever since. Now it's at 54 cents a share. Their dividend yield is a whopping 29%. That's a massive dividend. And the way you calculate dividend yield, it's annual dividend over stock price. As the stock price gets lower, the dividend yield gets higher. That's why the dividend yield is so high, because the stock price has come down so much. And it's good to remember that a company's financial performance is not always linked to their stock price. It can help or hurt the stock price. The only thing that's correlated to the stock price is supply and demand of the market. If more people want to buy this stock than sell it, the price will go up. And if more people want to sell this stock than buy it, the price will go down. The market is forward thinking, so investors look towards the future, not towards the past. So even if a company is doing really poorly financially, the stock price can keep going up. And the reverse is true. If a company is doing really well financially, the stock price may keep going down. So trying to understand market sentiment is part of investing. But if you find really solid companies with good fundamentals and hold their stock long term, you should be better off than most investors. The reason I focus on the financials is because all the information is there. If you listen to others, they could spin their story to make the company sound really good or really bad, depending on their narrative. Let's look at the financial ratios. They have amazing price multiples. The median PE in the market's 15.8, the average is 17.6. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 1.1, so investors are paying $1.10 for $1 of earnings. That's a really good ratio. The median price to sales ratio is 2.0, the average is 4.6. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.6, so investors are paying 60 cents for $1 revenue. Another amazing ratio. The median price to book is 2.3, the average is 4.8. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 0.4, so investors are paying 40 cents for $1 of book value. Remember, equity is total assets minus total liabilities on the balance sheet. They have a really good interest coverage ratio. The median is 3.9, the average is 12.8. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. It's also called operating income on the income statement. ROE is really good. The median is 12%, the average is 13%. ROE is net income over equity. So they're providing their equity holders with a really good return. They have a good current ratio. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities, so they can cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on 37 oil and gas midstream companies, and Oasis is right here. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're much better in price to earnings, price to sales, and price to book, all good ratios. They're doing okay in current ratio. Their ROE is much better than the average. They're lower in debt than the average company, but they're a really small company, only 242 million market cap. But I have a feeling that's going to go up a lot in the next year or two. And they pay a massive dividend of 29%. It's still not the largest. The largest is 36%. The average in the industry is 12%. So to summarize, I have them trading at a 16% discount. Their ratios look really good and their financials look really good, even though they're investing a lot in their business and their free cash flow is negative. So let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, get a custom valuation, or just support the channel, you can become a member by clicking the link in the description below. Every month, I will provide my members with an Excel file to help them better analyze stocks. Thanks for watching.